when it comes to the oil market. Now, we know about OPEC and Russia cutting their production. The Biden administration is that relentless war on fossil fuels. And now this domestic spike in demand. I'm going to bring in the Bianco Research President, Jim Bianco. Jim, crude oil, it's like the ultimate supply and demand commodity. But, you know, when you think of things like that, you think of yin and yang, right? A perfect balance, counterbalance. That's not always the case, though, right?
No, it's not always the case. Crude oil can go out of balance. Now, two things are driving it out of balance. Actually, three things are driving it out of balance. The first one we all know, because it's the big headline, that the organization OPEC Plus, which is OPEC plus Russia, is voluntarily cutting back on production to push the price up, and we blame them for the whole rise. Well, they've got some of the blame, but a part of the other blame is the economy is not going into a hard landing. It is continuing to move along, so we are demanding oil. So crude oil demand is up, as the chart you showed. The third thing, which really gets uncomfortable for the administration, is we're refilling the SPR. So part of that demand is now we're on the back end of draining the SPR. We're adding to it, so that's adding to the demand as well. And you add it all up, and not only do you have production being pulled back, and I haven't even attached to the green initiative in the United States to, restrict production here. You've got demand up, and that's why the price is up 34% in 10 weeks and showing no signs of backing off right now.
So is it then it's not unrealistic to think maybe West Texas Intermediate at $100 or more?
Well, no, not at all. I mean, it's almost $91 right now. Arab Light, which is the oil that the Saudis delivered, just went over $100 today. That trades at a higher premium than it. So there's no reason to think that the price is going to peak anytime soon. Now, $100 is another 10 or 15% higher. So that's, not out of the realm of possibility.
You mentioned refilling the Strategic Petroleum Reserve. I think it was earlier this week or last week, Kirby talked maybe when they were over in Vietnam about actually tapping it again. And you got to believe in an election year, gasoline gets over $4 a barrel. They're looking for something. Right? They go to Venezuela, they go to Saudi Arabia. And it feels like when the SPR is looming like a keg of beer at a frat party, I can see them hitting it again. I don't know how much longer it can last.
Well, I guess if I was to stick with your analogy, that keg of beer is down to basically pitchers with backwash in it right now, because the SPR is it's been drained. It's at a 40-year low. I mean, there is more you can drain out of it, but not that much more. And there's some engineering things. You can't take it all the way to zero, because then it will have all kind of engineering problems as well. So you've already used that, you've already used that option last year when we were jokingly calling it the Strategic Midterm Reserve.
Yeah.
I don't know if you could really call it the Strategic Presidential Election Reserve. That's why it needs to be refilled before you can use it again.
I just had Jim Grant on. He's made this ominous prediction about a secular bear market, 40 years of a negative bear market for bonds. In the meantime, we have seen asset managers load up like they've never done on bonds. They've said, this is supposedly a slam dunk. On the other side of that, we've seen hedge funds short bonds. Where are you in this? Where do you see bonds playing out?
I'm with Jim Grant, who, by the way, is one of the great institutions in the history of Wall Street. The guy is just such a legend. And I think we are in a 40-year bear market, too. I think it started in 2020, or a secular bear market. I don't want to necessarily attach some time to it. Secular means several years. We are now in year 4. That means higher interest rates. It does not have to end with 15% interest rates like the early 80s. But I do think that interest rates are going to continue higher. In a short answer, I think that the biggest economic event of our lifetime was the shutdown restart of the economy in 2020. It didn't come back. That reboot didn't come back the same. So we are struggling with whatever the new equilibrium is with the economy. We have simultaneous gluts and shortages, and it keeps inflation higher, and it's going to keep interest rates higher. To your other question real quick, Reuters did a survey of 29 bond strategists, and 23 of them said interest rates have already peaked. And they're about to make a new 16-year high, like within the hour here as we're talking. So the consensus on Wall Street is not that we are in a secular bear market in bonds. The consensus on Wall Street is that rates are going to fall, and contrarian opinion says that you usually want to do the opposite of what the consensus is.
I agree with that. Listen, I'm over time, and the producers are on me, but I have to ask you real quick because it popped in my head when you talked about this restart not going the way we thought. Did we do too much then? Could it have gone better if it was a more of an organic restart instead of pumping in trillions of dollars? I feel like that skewed everything, Jim.
I think that you're exactly right. I think that when we started to restart the economy and we pumped money into it, we set up a set of incentives for people to expect certain things. Don't go to work. If things get bad, there'll be a check in the mail. If you want one blunt answer to it, that is going to take a while to finally get people unlearned from.
Absolutely. Jim, thank you so much. All right, folks, let's bring in Real Talk Capital CEO Rob Luna.